while ETFs have been selling, gold holdings, we're actually seeing this year the largest demand for gold bullion coins in the US that we've seen since 2000.
It is actually an important metal. It's an important future metal. It's not just a metal with an incredible past as a store of value. So yeah, I think it is needed, it is necessary, has a broad use case, and it's not going away even in a world of transition.
Gold is a stabiliser. You should hold it in your portfolio, not because you're a gold bull and you think it's going to go to $3,000 and $4,000 an ounce. You have a bit like a stabiliser bar in your portfolio. It's your gold holdings.
So now to give us a little chat about precious metals, mostly gold, probably some silver as well. I'd like to welcome John Forwood, Chief Investment Officer at Lowell Resources Funds, Nicholas Rappel, Global Head of Institutional Markets at ABC Refinery, and Warwick Greger, Chairman at Far East Capital. So thank you all for joining us today. And maybe to kick things off, it'd be nice if we could get a short introduction to each of our panelists, share a bit about who you are, what you do, and maybe John, kick us off.
Thanks. Is that working? Mm-hmm. Oh, thanks, Amy. Thanks for having us on today. So John Forward from Lowell Resources Fund in Melbourne. We're a small fund which just invests in junior resources, mainly in the pre-development area. We're about 50% exposed to gold through our investee companies, so we're positive on gold. That's as a forewarning, and we're very interested in the dynamics of the gold market.
Thanks, Amy. Nicholas Rappel, ABC Refinery, an LBMA accredited gold refiner, gold and silver refiner. We refine about a third of Australia's primary doré and about 3/4 of their silver. My background, or my role there, is largely about relationships with banks and non-bank financial institutions that buy gold and silver overseas from us. My background prior to joining the business is a former gold and silver and platinum palladium trader in London and Tokyo. Then I moved to Hong Kong to grow business with clients that require hedging and price protection services, principally Australian mines, but also consumer company, automobile and oil companies as well that need price protection.
I'm Warwick Greger from Far East Capital. It's a company which started in 1991 with Andrew Forrest. It's evolved into a family office after a few decades. We manage our own investments. We do research, but we don't charge for our research because that tends to compromise it. Our objective is to make sure investors get good, honest, I suppose, advice on stocks, but we don't say buy or sell. We try and find out what the real story is rather than what's being promoted, and we communicate with our clients through a weekly newsletter, which some people find interesting, which makes it worthwhile. We raise money. We deal with companies in the exploration and pre-development stage. That's our specialist area, and we're very independent.
I find your newsletter interesting, Warwick, if it's any consolation.
Oh, thanks, John. I do too.
I'd like to be added to it.
And so, just a note to the audience, we will be taking questions throughout, so if you do have a question, just feel free to raise your hand, and one of my colleagues will bring over a microphone. To get started, recent announcements by the US Fed note that they'll be focusing on fighting inflation, and so keeping interest rates high for the time being. What sort of impacts of this note have you seen on the gold markets, and where do you see market sentiment heading from here? John, do you want to kick us off?
Look, I think in the last 6 months, since April, really, when the Fed started its hiking cycle, it has the interest rate effect on US dollar gold has been the overriding impact on the gold price. We've seen the gold price slide. Well, I guess it peaked in August 2020, but we've seen the gold price slide quite significantly down to, I think it got around to about $1,615 an ounce US. Recently, it's bounced off that level, and that slide's really happened since that interest rate hiking cycle has taken place. So it's been the overriding factor. But it's been interesting to me to see, really since the crisis which has started to emerge in the UK, and the Bank of England starting to support the gilts market there, which is probably, about 2 weeks ago, that we've seen a bit of a bounce in the US dollar gold price. We've also seen a bounce in the Aussie dollar gold price in that time. So we've seen the Aussie dollar and US dollar gold price move in tandem, sort of. And that suggests that there's other factors starting to emerge, which are not just related to the US interest rate cycle.
Yeah. So with the interest rate cycle, I think the theme for the tightening really is about higher terminal rate for the Fed, and for longer. Of course, the rate will eventually, there'll be an easing cycle, but the easing section of that cycle, I think, is moving further away. Just to give you an idea of how that's moved just in the last month or so, the world is expectations around Fed tightening have moved from roughly 4% as a terminal value, say in May of next year, to about 4.6% just in the last 4 weeks. And I just want to say a couple of things about sentiment, but also about where could we go from here in terms of that terminal rate. The Fed is coming under a lot of pressure, both internally and certainly externally, from people who feel not unreasonably, and apropos your comment about the Bank of England and BOJ, and they're sort of intervening in yen and sterling and in gilts, or gilts principally in the case of the BOE. Is the Fed too tight? It looks tight because it's come from almost zero, and it's looking at converging on this 4.75%, 4.75% level. But actually, if you look at it via the tools that they use to set monetary policy, and you factor in current inflation, actually the Fed could yet go further, and that would have all kinds of implications, probably drive the broad dollar strength even higher, and probably break a few things in the process. You're already seeing some problems worldwide. So this tightening cycle could yet run further. When it comes to sentiment, just a few sort of comments around that. It's one of the sort of metrics that I look at to sort of gauge sentiment, is how people are positioned in the COMEX, because it's a publicly, it's a data source where people can see it, and it might be the sort of, I wouldn't say tip of the iceberg, but it's fairly black and white what people are doing there. If you look at managed money, investor fund positioning, if you look over the last 10 years, I think the average net position in managed money is about 9 million ounces long, roughly. So generally, on balance, that long. The position at the moment, as of last week, is 670 or 700,000 ounces short, and the week before was 4.3 million ounces short. And for pretty much all of this year, the position has been well below. It's not either been negative or well below the average. So what that's telling you from a sort of investor sentiment and what they're actually doing, they're placing either substantial bets against gold, or they're not committed to being long of gold. When gold went down to the 1615 level, that coincided with a shift in sentiment in terms of what the Fed was going to do. There was a brief period where people thought, hey, the Fed might back off a little bit. And people who were betting against, betting on a gold sort of decline, very quickly reversed some of those positions. So we saw about 3 million ounces of short covering just in that week alone. So it's probably concerning that pretty much all the buying in gold and silver in the last week viewed through that futures lens is actually from people betting against gold and silver, buying back, rather than people putting on fresh positions and saying, look, this is a great level, let's get long. So I guess, I don't know, that's my takeaway from sentiment.
Well, I see the tightening of the rates that we've got now is actually a reversion to the norm. We've had a period where interest rates have been ridiculously low. And it's one of the basic things they teach you when you're studying economics is the best way to have low interest rates is have high interest rates now, and the inverse that applies. We've had an extraordinary period of wealth creation through the banks throwing money into the system. The interest rates couldn't stay down like this forever. We've had inflation for a long time, but it's in financial assets and property prices. It's starting to come through to consumer products and labour now. The interest rate level we're at now may well only be halfway to where we're going, because if we're reverting back to the norm, you're going to have to get worse than this in terms of higher interest rates to actually crush the inflationary cycle. But the other point is it's not so much demand push inflation, it's a supply problem. We're going back to a time very much like the 70s when you had the oil price shock with OPEC, you had the Yom Kippur War. It started a cycle of inflation that got a life of its own. Very similar to what we've got now. But this time around we've got more flexibility because of floating exchange rates. The central bank's monetary policy is a bit more hawkish than it was then. People just accepted it back in the 70s and going into the 80s and had all sorts of problems. So where does this go? The real problem is supply, energy supply, and that brings into play, we're facing up with them to the music that this battery revolution, alternative energy, shutting down hydrocarbon power sources, it's all coming into play in this big mix. And, you know, you can use monetary policy to crush inflation, but as they say, it's a very blunt stick. What needs to happen is the governments need to be addressing supply on a lot of fronts, whether it's because of supply from China, which is tied up with trying to stamp out COVID, whether it means bringing out more hydrocarbons, oil and gas to keep energy prices down. There's no initiative from the government with that, so it's problematic. As far as all this relates to the gold price, over time, the gold price will be affected by any one of a dozen different factors, depending on what's popular at the time. We all know that if interest rates go up in America, the US dollar will go up. That'll drive the US dollar gold price down, which is exactly what we have happening here. But in Aussie dollar terms, it's fantastic. I was cleaning out my drawer the other day and found 20 1-ounce gold coins. I remember they cost me $750 back in the late 80s. Well, they're worth $2,600 now. If you're looking for a good reason why you should have gold, well, that's a pretty good reason. I'll have to look through another door and see if I can find some more.
I mean, bringing that around to, you know, there's this idea, which I'm sure still holds quite a bit of weight, about gold's role as a safe haven investment, and as it should be a part in any investment portfolio. Has this changed with the growing discourse on the energy transition? And I mean, there was a panel yesterday where one of the miners, who was, you know, a very green miner, very much focused on decarbonizing their operations, but they were a gold mine. And so the question came out of, do we still need gold in this day and age? What's your take on that? Sure.
Well, I think when it comes to a sort of portfolio role, there's really good, robust evidence that it's a good diversifier and it's a good thing to have in a sort of a traditional portfolio. So yeah, absolutely does have a role. I think the other thing is as well is it's probably worth just very quickly revisiting the use case for gold. You know, yes, we tend to think of gold pretty naturally as an investment product and as a jewelry product, an adornment product. In a lot of countries, the jewelry and investment are pretty synonymous, actually. Anyway, there is that role, but also there is not a person here who doesn't rely on gold literally as we sit, because all of your mobile phones, your mobile devices are full of gold bonding wire. It's used as a catalyst, for example, in monomer production, and there are various other catalysts for very mundane sounding things, including building manufacture and so on, where there is thousands and thousands, probably millions of tons of chemicals produced worldwide that's vital for new builds. And some of the way that stuff is made in an environmentally sound way uses gold catalyst as a very, very recent thing in the last sort of year or two. So it is actually an important metal. It's an important future metal. It's not just a metal with an incredible past as a store of value. So yeah, I think it is needed. It is necessary, has a broad use case, and it's not going away even in a world of transition.
I think just on your point, Amy, about do we need gold, and what are the environmental considerations of mining gold? I think we do need to be aware or cautious of a backlash, if you like, against gold and gold mining and use of energy for that purpose. The one extreme could be that we see investors abandoning gold mining companies because they don't deem it to be the appropriate use of energy. The extreme would be like we see in fossil fuels. Numerous investment groups are saying, well, we're just not going to invest in fossil fuels anymore. I think the gold mining industry does need to be aware of that risk. Taken to the extreme, coal companies are making bucket loads of money at the moment, but their multiples, they're trading on relatively, or have been trading on relatively low multiples. So we do need to be aware, the industry needs to be aware and make those points that Nick just made about, look, it's not a useless barbaric relic. It's actually a very useful thing. And the reason why the price is so high is because it is so useful and so sought after.
Yeah, well, I see that the gold price, gold mining companies, they're rather well insulated from all this alternative energy, batteries, material. The world's going through what I actually see a bit of a man-made disaster, in that it's swallowing the CO2 argument when there's a lack of substantive evidence that CO2 causes global warming. There's a good argument to say, well, global warming causes the release of more CO2, so is it chicken and egg? But we're going through changes which are disruptive, and anything that's disruptive makes gold a better bet. So I think that gold is a stabiliser. You should hold it in your portfolio, not because you're a gold bull and you think it's going to go to $3,000 and $4,000 an ounce. You have a bit like a stabiliser bar in your portfolio. It's your gold holdings. And, gold is nowhere near as bad a carbon emitter from the mining operations as many other. When you produce gold, you fly it out on a little plane. You haven't got a lot of transport costs. If companies can go and use alternative energy, that's great if it works. But I don't think that gold is vulnerable to the changes. If anything, gold will become more valuable because people want to get back to grassroots and what they feel safe with in an increasingly disruptive world.
I think that, just picking up on your point about being a stabiliser to a portfolio, it hasn't performed that well in US dollar terms over the last 6 months, which is a relatively short period. But if you look at the Aussie dollar gold price over the last 12 months, it's pretty much exactly matched inflation. In Australian inflation, about 6.5%, and that's pretty much what Aussie dollar gold has done. So from an Australian perspective, it's been a wonderful stabiliser. There's not that many asset classes that have gained 6 odd % in the last 12 months in Australia.
Yeah, and I think if you were holding gold in your portfolio in sterling and yen and a number of other currencies, you'd absolutely be very happy to have that allocation for sure.
And speaking in favour of gold companies, you produce it, you sell it. The techniques, there's no technical risk with them. It's a beautiful company objective, especially smaller companies. If you're looking at all these alternative metals, whether it be cobalt, graphite, lithium, they're all industrial products of some sort. You've got to line up buyers. The future is very cloudy as to how much is coming to the market and who the buyers are going to be. But with gold, you produce it, you sell it the next day and you've got the cash. And there's no better commodity for a junior mining company in particular to be participating in.
So Nicholas started touching on kind of the industrial use of gold. I thought we could look at silver a little bit. In the Singapore event that we ran last week, one of the investors on the panel said, you know, maybe it's not a precious metal anymore. Maybe it's an industrial metal. What do you think about that?
Yeah, no, I think it's a completely reasonable thing to say. And I think also that, I mean, and that's not to diminish silver as a precious metal in any way, but the reality is silver, firstly, it kind of has a dual sort of personality when it comes to its price behavior. I often say that sometimes it seems to follow the kind of industrial path, quite well correlated with copper, for example. And at the same time, or alternatively, it may pick up more of its directional cues from gold because it is a precious metal with it's kind of more, I suppose, beta than gold. But if you look at the use case for silver, it's even broader than gold, and it's an exceptionally useful metal. It's a metal that, you know, again, I sort of said this about bonding wire, but you literally would not get out of bed in the morning, go to work and come back without having some exposure to stuff that's been processed by silver. It is the catalyst for pretty much all of the precursor chemicals that we use in our daily life, whether it's antifreeze, the stuff used to clean your clothes, may have gone over time. All of these things that actually we rely on, shampoo, all of the stuff that you use in the modern world relies on obviously sort of bulk chemicals, and those bulk chemicals are very largely catalyzed over silver and other metals too, but silver is an absolutely key one. So it does have a kind of like, if you like, an industrial angle. It's obviously, and we've seen a lot of this in this past year, largely I think geopolitics and currency moves, is it's an incredibly popular metal with a sector in the investment community that wants to buy retail-sized bars. So it's almost got like a dual sort of nature in that sense. But yeah, I mean, perhaps going on from that, one thing that's maybe a vulnerability for silver next year is if we do have a hard landing because of, you know, a considerably tighter sort of monetary environment, not just the Americans, but, you know, across the world. If there's a hard landing, obviously that's potentially a vulnerability for silver at some point during the course of the year, if you look at it through the perspective of being an industrially influenced metal, even if it's not a metal you consider industrial all the time.
Yeah, the silver, from an investor's point of view, the biggest market for silver coins or bars is actually in America. The Americans get more enthusiastic about silver than gold for historical reasons. If you're looking for silver, Australia's a hard place to go and find it in economic grades and quantities. But in the Americas, especially up and down the Andes, there's heaps of silver. It's cultural for Americans. And you have to, as Nick was talking about the industrial uses, yeah, it's actually quite good because a lot of those uses are terminal. With gold, all the gold that's ever been produced is sitting in someone's vault or on someone's finger, where silver does get consumed. So the correlation over the years, over the last 10 or 20 years, the ratio of gold to silver in valuations has been falling. And people used to trade silver on the basis of, well, it's the disparity is too great, so buy silver now, switch out, do a swap out of gold. But that seems to be a bit passé now. And it is a cyclical metal according to expectations that are linked with gold, but it's not a complete correlation.
Nick, can I just ask a question about silver production? Like, we've seen a lot of curtailment of base metal refining, particularly in Europe, due to the energy crisis. And a lot of those cons will have a silver con to them. Are we seeing a reduction in silver production as a result?
I think looking at the world silver supply, I've actually got some of my notes down there, but I'm not going to look at them now. I think, yeah, there is a bit of curtailment. There's certainly a bit of a deficit. We're not seeing that, because we don't get any sort of, con or any doré from overseas. So we're not sort of seeing the sort of flow back from that. But yeah, it's quite likely that what's going on in the sort of concentrate world will have at least a marginal effect on silver supply. Yeah, basically. It's hard to put a number on that. That's the thing.
The thing, my comment about that question about industrial versus investment for silver. I think there's we saw silver go to $30 an ounce. When gold got to over $2,000 an ounce in 2020, and then we saw gold come off. What's that? About 15%. Silver at the same time fell from $30 an ounce to 18, or even lower. So that's getting on towards half. Yes. So the leverage and the response to gold price and the way silver follows, but exacerbates the gold price moves, tells me that there's still a massive investment, a drive to the silver price.
Yeah, that's right. I mean, it's hugely popular, and as Warwick said, there's a sort of a cultural and historic reason why silver is particularly close to parts of Americans in particular. I think they sort of actually were having a big argument at the late 19th century about whether to go on to a silver standard and so on because of various issues around gold. But there is a huge investment side, both in the ETFs and in the futures investment side. And in fact, going back to what we were talking about, gold and short covering there, is between September the 6th and October the 4th, I think it was something like 132 million ounces of buying just from people who'd sold silver futures and wanted to get out of those positions. On the flip side, fresh buyers who were buying futures longs and saying, okay, I believe it's going to go higher, and those guys have been quite happy. They bought about 20 million ounces. So it's kind of interesting, but yeah, it's the big investment space. I think there's just shy of a billion ounces, I think, held by silver ETFs globally. So yeah, that gives you an idea at least of the scale of silver investment.
Going back a bit to my earlier question about gold and the ESG values related to it, a lot of debate, and we had a lot of debate last week in Singapore about the gold versus crypto space and whether that debate holds any weight. And earlier today, one of the panels suggested that there's just a general lack of interest from younger generations into the gold space. And so they have been looking at these other investment opportunities. What do you say to that?
Well, as an advisor, I don't know how you can value cryptocurrencies. At least gold's not going to disappear. I think that the rise of cryptocurrencies has had a lot to do with the excess liquidity that's been pumped in since the GFC. Easy come, easy go. You've got a lot of young people who are trading it as a gambling instrument. That's all it is. You can't call it anything else. And they're the sort of people that these higher interest rates, crashing markets, whatever, the market's going to take a lot of that money back from them because they don't deserve to have it anyway. You're talking two complete opposite ends of the scale if you're talking investment quality and objectives. One is just complete and utter gambling, and the other is something that's been stable for thousands of years that's not going to disappear. And those people that are just punting, with the COVID, everyone stayed at home, punted the stock markets, and long-term players in the markets would say, well, markets shouldn't be behaving like this. You know, there's a lot of risk involved in this. What's going on? But it's just a function of bored people punting. Now, I don't see that you can say anything rational about cryptocurrencies other than it's just like another gambling tool. Gold is something that goes up and down, but within acceptable margins. There's a lot of gold traders around in the world which will drive a price. They like to have a certain amount of volatility because they can trade it. Now, I'll relate a story that goes back to the 1980s when I was a gold analyst at County NatWest. Every Friday afternoon in New York, the gold price used to move. The biggest moves of the week were always when every other market but New York was open, was closed. New York was open. And then the next morning when they were trading gold in Hong Kong, that would then set the tone for the following week. And I said to one of the world's biggest gold traders who worked for Citibank, I said, you know, I've got this theory that you guys go out and have a pissy lunch and come back having decided, let's move the gold price. And he said, yeah, well, that's what we did. And one of these afternoons, they decided, let's spread a rumour about the Sultan of Brunei buying gold. And they spread that rumour and the gold price started going up, probably put on $30 after lunch that day. Someone else from Citibank rang up and he said, hang on, I manage the Sultan's money. He's not buying gold. And so the trader said, oh, well, what's the best way to back out of this? And he got on a plane, flew to Brunei and told the Sultan he should be buying gold. So the Sultan started buying gold. But, you know, that's New York, that's trading desks. A lot of movement we have in the gold price, people would always say to me back in those days, well, they'd ask me, why is the gold price doing this? Why is it doing that? No one really knows. They'd come up with something that sounds credible and that would reverberate. But, you know, we shouldn't try and be too scientific about why the gold price moves. The fact that it is moving is good because that's volatility. Traders make money out of volatility. You've got to have turnover. If it's flatlining, it's boring. But we shouldn't get too worried about why it moves $20 here or $30 there. We shouldn't necessarily be looking for trends that are going to carry on for a period. There's a lot of guessing, double guessing. You can short, sell. You know, you need to understand that a good market by nature has an element of chaos about it. And that, you know, we just should get used to it and not worry that the gold price is going to collapse because it's going to be abandoned.
Yeah, I largely agree with particularly the substance of the Bitcoin and or crypto discussion there. Look, to me, I think that one of the reasons why crypto and gold often get conflated is because there's a section of both communities that kind of think that they're the AK-47 kind of wielding insurgents of the financial game, and that they're going to emerge from the jungle at some point with the other institutions that we're used to for a long time somehow vanquished. And certain type of investor that's common to both of those assets sort of has that belief. But actually, they are really fundamentally different. As Warwick said, the history of gold is a genuine store of value, and in times, even a store of an actual means of payment is well established and has been for a very long time. Whereas crypto, and I guess really crypto is really only about three things. There's a long tail of stuff that we're not even sure what the use case is for. That's not well established. And the correlations, for example, we've seen a huge sell-off in tech equities, and Bitcoin's largely correlated to that. And it suggests, that, well, to go back to what happened in COVID, that largely the same people who are believers in tech are also avid believers in crypto until they're not. I think they're very, very different things. One of my colleagues made the point, which I think is an important one, is that I think you alluded to, Amy, is that younger people like crypto. Good thing about younger people is they become older people, and then they develop a taste for gold. But it is largely about trend following in crypto, without really, you can talk about all you like about sort of Bitcoin and maybe natural constraints on the price on the downside, but actually it's not a well understood thing, and I think a lot of it is just a huge amount of trend following. And certainly up until the point where it broke.
I think in terms of the generational question, we were asking ourselves that sort of pre-COVID, and is the next generation going to invest in dirty old mining or whatever? And then we saw a huge boom, through COVID, in resources stocks and everything else. So, look, I think every generation is really interested in making money, and if there's an opportunity to make money in gold mining, that will be taken by everyone from age 18 to age 80, I think. But just interesting on the sort of the crypto versus gold versus physical gold in particular. We're seeing while ETFs have been selling gold holdings, we're actually seeing this year the largest demand for gold bullion coins in the US that we've seen since 2000. And the price of gold in 2000 was what, $250, $300 an ounce. So there's a bit of a disconnect between the ETFs, which do seem to have a very big influence on the price. Physical investors, both in the West and also in Asian jurisdictions, and also central banks. We've seen 6 months straight of central banks net gold buying. So, look, I think that perhaps the longer term investors are, accumulating physical gold, and you might say the ETFs are a little bit more volatile, shorter term investments, and they've been reducing their gold holdings.
Before we kind of change themes a little bit, do we have any questions from the audience? Yeah. You've got a microphone.
I'm just thinking of a potential scenario. What would happen if a few of the central government or central banks starts collapsing because less and less people are trusting them? What will happen to the gold and silver value in particular? Just use your imagination, I suppose, and your experience.
Well, we have seen, like in Ukraine, I don't know if their central bank is collapsing. I don't think it is, but they certainly have been monetizing some of their gold holdings. Nick, you might know the exact numbers, but since the invasion in February by the Russians, there's been a significant amount of selling by the Ukrainian central bank. But that's been obviously soaked up on a net basis by other central banks, and yeah, look, it probably has had some impact on the gold price at the margins.
Yeah, if you think that the central banks, they're to some extent agents of government monetary policy, it's what they do that affects us all, as opposed to what they've got. So if a central bank gets in trouble, it's because it's doing things it's not designed to do, and that would result in regime change and disruptions and uncertainty, and that's always good for the gold price.
Yeah, I think when you talk about, say, the central bank collapsing, it's not really so much the central bank would have a problem, or rather the problem would manifest itself in the national currency, the bonds that are issued in that currency, whether they're sovereign bonds or even corporate bonds, because they would all be affected. If the Venezuelan central bank is still a thing, but what's going on in the economy and sort of Venezuelan assets is where those problems, policy problems, materialize. The other thing is, as well, is that depending on what kind of problem the economy faces, and depending on how the central bankers try to engage with that, in a lot of situations, either other central banks and the Fed, ECB, depending on which currency some of these problems manifest themselves through, they actually have really, really large swap lines in place to try and buffer what's going on with a country's external account. So there are buffers in place for that. If the problem manifests itself through, say, capital account issues as well, there is always the IMF. Now, those aren't sort of huge reserves of ammunition, but it's unlikely that there would be a wholesale collapse of a sort of medium-sized country's currency. It can happen, but there are quite a few buffers to work through and sort of policy prescriptions to work through before there's like a collapse, as it were.
While we're talking about central banks and their role, it's important to observe a paradigm shift in markets over the last 12 months. When Greenspan got into power as the head of the Fed, he had a policy, and he was around for decades. The policy was, well, if there's a disaster, if this country has a default, if there's some economic accident which is going to threaten our equity markets, he had a policy, well, we can solve that by throwing money at it. And he won a lot of fans over a long time as we went through that very long US bull market in equities. And we all got to the position, well, the Fed's always going to step in and save us, so we don't have to worry about the market falling. It might fall 5 or 10%, but it'll quickly bounce back. We lived under that umbrella for quite a long time. But remember what conditions were like, what inflationary conditions were like over that extended period. There basically was no inflation. We're in a situation now where we're seeing the equities market crap out. The Fed can't throw money at it. They can't throw liquidity into it because that's going to exacerbate the problem which is causing the markets to go lower, which is inflation. We have departed from that period of history, and again, it's reverting back to the norm. We were living a fairy tale while the Fed had our back, but now you can't do that when you've got inflation because that just makes the problem worse. So that's something to keep in mind in any of your investments, especially in equity markets at the moment.
Yeah, I appreciate that point. But just like last week or so with the Bank of England, what they did for their pension fund there, they sort of reversed course back to stimulating a little bit and sort of averted the collapse of their pension funds. I'm just thinking like potential scenarios. What would happen if less people are trusting the central bank? If they try to sell their bonds and treasuries and there's no more buyers, even if they try to print money to buy it, but then who's gonna? You can't keep going with that cycle forever. At some point, it has to break.
They run the risk that you have another period like when they say George Soros broke the Bank of England. The UK is in a complete mess on its monetary policy and politics, but that's in one country. Once upon a time, when the UK was in the European Union, it was a key player. Now it's not. It's actually almost irrelevant. And it's a start of a continual decline that started back in the World Wars. The European Union helped the UK get a prominent position, but it surrendered that. It's becoming, at best, a middle-sized player in the world economy. If they have problems there, it's going to be country-specific. People will drive down the currency. Maybe the UK people, the investors, will buy gold, but it's not a reason why everyone else in the world will buy gold.
Yeah, and sort of to go on from that, you're seeing the outcomes of those policy errors largely triggered by the incumbent government, but also perhaps exacerbated by some missteps by the BOE, Bank of England, and you're seeing that come through the currency market very, very quickly, and you're also seeing it come through the gilts market, the sovereign debt market, very, very quickly. You're seeing a really, really sharp sell-off, some really hideous numbers in terms of the sort of bad performance of UK gilts. And the problem is, without kind of necessarily extemporizing on what's happening in the UK bond market, one of the things that's, just to give you an idea of how these things kind of go wrong, having tried to step in and say, okay, we'll try and provide some kind of support here, one of the, I think a communications error by the Bank of England was to put a time limit on that support and also put a little bit of a value on the support. So because it's kind of like got a time expiration on it, that's painted a target on the back of the bond market, because it's allowed other people who have a natural interest in buying and selling bonds to say, well, I don't want to get involved here, or I'd rather sell them here. And that will probably, almost certainly is, increasing the volatility of that particular asset. So that's, I guess, a pretty micro discussion around how central banks can make communications errors. But look, I don't think central banks themselves, they don't go away. But what happens is the assets that they're, if you like, their policies are entrusted with prudent behavior, those assets suffer, whether it's the bond market or whether it's the currency exchange rate.
Yeah, well, on that, nowadays we have a system of floating exchange rates. So it's a self-correcting system at the end of the day. It'll be repriced to what the rest of the world thinks the currency's worth, and we move on with life.
We have a question over here.
Yeah, I'm just trying to refresh my memory. The GFC, when there was a hell of a lot of financial strain, some people were arguing the whole system was about to go up its own backside at the time. It was pretty scary. Can you just remind me how gold went through that period? And was there much selling of gold because the backside had fallen out of everything else that people then had to sell gold as well because it had liquidity?
There was definitely, selling of gold. The gold price fell. I think it might have been something like between 10 and 20%, in 2008 between Feb and October. And like now, there was a flight to the US dollar. Pretty much everything got sold and everyone just wanted US dollars. But in 2009, you started to see the gold price and other assets rebound, partly because of what the Fed was doing. But, the gold price had a really strong run there through to 2011, 2012. I think it might have been, up, at least double in that period. So short-term shock to gold price, but over the longer term, it actually performed very well.
Nothing really to add to that, except it's probably worth bearing that in mind the next time we go through some kind of shock, is that gold absolutely would be an asset you'd want to be in, but depending if there was another, unfortunately Lehman has been a kind of a portmanteau for any sort of disaster, but if there's another Lehman moment, you'd probably see people converting gold into cash in the short term before the gold price recovered.
Can I just ask, John, the point you made about there being strong demand physically from central banks and coins and whatnot, if you looked at a curve of demand and then looked at a curve of price, you'd come to two different conclusions over the past sort of year or so. How do you see that playing out, or why is there an apparent disconnect?
Look, I think, the fact is that the derivative or paper market in gold is massively bigger than the physical market, and that's the price that we see is the ultimate the paper price, if you like. But look, I think taking a massive step back, currencies are actually an artificial creation, created by humans. And gold is not. Physical gold is not. So, over the medium, definitely over the long term, you would see, destruction in value of all currencies, whereas gold, it generally maintains its value. Yeah,
I think sort of adding to that, the reason why the sort of gold is an asset class along with many others, so it responds to what's happening in other asset classes, and particularly probably if you look at it from a statistical basis, it's probably the single biggest driver and explainer of the worldwide gold price is what's happening in inflation-linked bonds. So it's got a tremendously high sort of explanatory variable for what happens in gold. And as John said, it's the worldwide market for gold is huge. It's a very large and liquid market. What you tend to see when you see demand for bars and coin is you actually see that expressed in a different way. You can see the gold price maybe decline because the larger macro currents might be driving the price lower. What you see is you see premiums go up. So someone wants to buy a kilo bar loco Singapore or Hong Kong, whatever, that might be $2 over the spot price, but in times of very low demand, it might be 50 cents. So that's the kind of window through which you see the impact of that physical demand.
So we have time for one more question from the audience.
Hi, it's two, but maybe I'll try to turn it into one. Now I'm an equity analyst and I gave up trying to pick the gold price years ago, but new investors still ask me about it. And this is a very general question. I think they look at it as a commodity, so they want to know if annual gold production has any effect on the gold price. I think it probably doesn't, but you guys might have a different idea. And the second question is, we talk about different economic metrics, whether it's interest rates, real or nominal, inflation, people's expectations of those things. Which, if any, has the strongest correlation to the gold price?
The actual mine production is not really all that relevant. It is to people who want to be extreme fundamentalists, but that's not how markets work. As I said earlier, what's impacting on the gold price can be one of 10 different factors that come in and out of fashion. I think the best way to predict where the price is going to be is look where it was 3 weeks ago and focus on what is driving sentiment at that time. When back in the 80s, I did a study, it looked at all the different aspects and really there is no everlasting correlation because of the high level of emotional decision-making that gets induced, and what's closest in people's memory is what has the biggest effect on what they're going to do.
The fundamental side of it is, put it this way, if you look at the amount of above ground stock in gold, it's probably one of the most well-stocked commodities going. That doesn't mean that all of that gold is necessarily free for consumption because some of it may be tied up in reserves and so on. But ultimately, the sort of supply-demand picture, it's important to, sort of on the margin, if you can't supply, for example, a particular kind of bar that people want in a particular territory, that's important, but that's a very micro thing. If you're looking at annual world supply and demand, not really. In terms of the sort of three things that I tend to look at, and you're absolutely, like Warwick's right, there are correlations come and go, but I think the most durable thing that I would look at is the yield on 10-year Treasury inflation-linked bonds, TIPS, in the US for US gold. The other thing I look at is the dollar index. Over the long-term dollar index, as a broad measure of dollar strength and weakness, the correlation is even less durable, but it's nonetheless, you can't avoid it, and it's been a key feature in the last year. Crude also has a relatively good sort of predictive, if you like, characteristic. I think the R squared or whatever in a regression analysis is about 0.8, which is pretty good. It's not as good as 10-year yields, though. So those are the three things I tend to look at. And then the rest, I know that there's some great memes on Twitter about how this is astrology for men, but I'm a committed chartist.
One minor thing I'd add is just producer hedging. That's obviously selling gold into the market. I don't have the data, but anecdotally, we're seeing fairly muted hedging at the moment by major producers, at least here in Australia. The Northern Stars and those sort of people. So I don't think there's a lot of pressure coming onto the market by producers in forward selling their gold.
On hedging, the higher the interest rates go, you'll get more and more hedging taking place, forward selling. If you go back to the 80s, a company like ACM, they were getting an 18% growth in revenue on gold price alone just because of the interest rate. They were making a fortune because of their spot deferred delivery. With inflation, interest rates coming down to near zero, there wasn't that margin to make. What was a bigger influence on the gold price were currency movements. But as interest rates get higher, there's more and more incentive to sell forward. And it could get to a point where that does have a material effect on supply. If you go the annual changes in supply from mine production, it might be 1 or 2%. That's why people like gold as a store of value, because you can't flood the market with new gold like you can with paper money. But where you get a lot of companies, if they all decide to sell forward, that is when you could have a material dampening effect.
Interestingly enough, if you look back at, I think quite some time, like 20 or 30 years ago, and you look at kind of all the sort of various factors that should have given you a rough idea of gold's kind of progress, there's actually a sort of a real disconnect at one point where there's a spike up in the gold price. And part of the reason for that, I think, or one of the contributory factors to that, was there was a massive amount of de-hedging in the producer sector. And in that year, the demand from de-hedging alone was pretty colossal, actually, over that 12-month period. You can actually see the gold price kind of at a time when a lot of other things, the dollar and yields and so on, would have suggested no real movement in the price. You can see this, basically a lot of producers being stopped out because their margin calls and positions they had, there was a sort of sea change and saying, well, let's not be hedged. Let's ride this trend higher.
Well, I feel like we can keep going for another hour, but I am conscious of time, and some of our panelists have to get onto meetings. So I think we need to end things there. Thank you all for your insights. It's quite an interesting conversation.
Thanks, Amy.